All right, so for the stock investor workshop this week, I thought we could take a look at going through a screener and focused on one particular industry. How you doing, Tomas?
Hi, Victor. Hi, everyone. Everything's fine. Sorry for being late.
No, that's fine. Thanks for joining. Thanks for joining. We just got started, so you didn't miss much. All right, so taking a look at when when you think about, okay, hey, I'd like to find a good stock, and a good part of managing a portfolio, in my opinion, is diversifying. And diversification is about, picking out stocks, and I might have a good slide to show you. And where do I have that? I don't think I have one readily available, but diversification is a way of getting some of the risk out of your investments. Like in my case here, right, I've got companies that are in communication services. I've got companies that are in consumer discretionary, energy, financial services, healthcare. So if, for example, just consumer discretionary is down, then maybe financials is doing better or healthcare is doing better. So at any one time, the companies are performing and making money and going up in value. Some of them are dropping in value. But what you want is collectively the whole portfolio to do well, good performance, but you can manage your risk by diversifying across different sectors and different industries. So an industry that was brought up recently was aerospace and defense. And there's the number of sectors that are out there. Let me go through that and then I'm going to get to the industry. So the primary sectors where stocks are classified, there's 11 of them. Financials, healthcare, technology, industrials, consumer discretionary, materials, real estate, energy, communication services, consumer staples, and utilities. So we have thousands of stocks that get categorized into one of these sectors. And then we would go into a specific sector, which we're going to go into industrials. Okay. Within industrials, there's these industries. So there's aerospace and defense, there's electrical equipment, marine shipping, there's metal fabrication, airlines, railroads, all kinds of stuff. Okay. And all right, good. Now, with my life experience and kind of business experience, I know that aerospace and defense is one of those industries that is unique. And some of the things that I like about that industry is that it's quite stable. To kind of put it in big terms, is the United States. We have the armed forces, and it's not like we go from 1 year to the next and go, you know what, we had an army last year, but I don't think we're going to have an army this year. It's not the case. It's like, no, we had a strong army last year. We're going to have a strong army this year. We're going to have a strong army next year. We're going to have a strong army in 5 years, 10 years, and so forth. So aerospace and defense tends to be held up by the fact that, a strong country has a strong Department of Defense. So that's part of why this industry is stable. It's also stable because most of the contracts that are awarded are long-term contracts. For example, you have Raytheon, and they might have a 10-year contract to provide their equipment to the Army, Navy, Air Force, Marines for the next 10, 20 years. If allowed, this same aerospace and defense company, if allowed, can also sell their weapons, equipment, infrastructure to other countries. Again, has to be friendly countries and the United States government. For a U.S. company, which I think we're looking at, mostly U.S. companies, will say, yeah, it's okay for you to sell to Canada. It's okay for you to sell to this friendly country, but it's not okay for you to sell to North Korea, as an example. All right, perfect. So one of our members came up with Lockheed Martin, and I took a glance at it, and I liked what I saw. And instead of just focusing in on one, what I thought would be a good kind of workshop item, because I know, Tomas, you've asked in the past, hey, how do I find a good company to invest in? So I thought we can take a kind of a big picture kind of point of view that you can use a stock screener to analyze, and then drill down until we find kind of like the best one or two companies within this industry that we can consider investing in. So that's going to be what I hope to cover over the next 15, 20 minutes. All right, so let me show you some analysis that I was doing a little bit earlier today. And I'm not meaning to overwhelm you, but let me first start with here. Okay. So here are 75 stocks that belong to the aerospace and defense industry. And that industry belongs to the industrial sector. And we can see that, oh, this is sorting them from the biggest one to the smallest one based on market cap. Now, which one's the best one? Well, that's a bigger question. And how can I basically filter this so that I could just see the best ones? Well, what I did is I do have a subscription to Stock Analysis. So it allows me to export, and it allows me to add some more fields that I want to look at. And I did that on another sheet, and I basically have a pretty broad data set, right? I'm looking at the revenue growth, I'm looking at earnings per share that is expected, and most specifically, the PE for 2025. I'm looking at the free cash flow ratio to its stock price and so forth. So I took this big data set, sorted, then I got to a shorter list. Okay, and I was basing it mostly on, I sorted on the forward PE. You can see that these are relatively, I'm going to call them reasonable. It's not like they're super low, like automotive is like 7 PE, forward PE, or even energy is down to like 11. And then the price to free cash flow forecast, the price to free cash flow ratio. So what I did is I took kind of some that looked the best based on those ratios. And once we got to this list, then I sorted by the price to free cash flow ratio specifically. And I'm also looking and keeping an eye on what analysts are saying. Hey, do they think it's a buy? Because that usually, I may not completely agree with them, but it's also, it doesn't hurt if I think it's a good stock and other analysts think it's a good stock as well. Scott, go ahead and ask.
Thanks. Yeah, just looking at your spreadsheet here, a couple companies, so like RTX and Lockheed, the price to FCF ratio look almost the same as the forward PE. Is that just a coincidence?
Here?
They're completely different numbers, right? Yeah, so specifically I'm looking at the two companies at the top. Their forward PEs and PE FCF ratio are almost the same. I assume that's just a coincidence because it's not always the same.
Yeah, I think so.
Okay.
Yep. I didn't look at that, so it's I'm not quite sure why. So this PE ratio here is for the current year, and then this one's for 2025, and we're so close to 2025 that I'd rather look at that number. And you're referring to which other ratio were you looking at?
Yeah, the two columns, the columns N and O that you're looking at right there.
Yeah,
so
really close. Isn't that neat?
Yeah, you see
pretty
what I mean?
Close. I do, and I think, I don't know if there's a conclusion we can form there.
Yeah.
I think it might be coincidental. Yeah.
Okay.
All right, perfect. So when we look at this, we're going to look at it more closely, and we're going to look at a couple other things. But what I began to do, okay, so now I went from big picture, hey, I'm trying to manage my portfolio, and in doing so, I like buying companies in different sectors and industries that could help me balance out my risk. Meaning, if let's say we got into a bad economy, aerospace and defense does really well because it's not going to go down. It doesn't matter if we're like in a recessionary period. The government's going to continue to buy airplanes, tanks, guns, bullets, equipment for the armed forces. That does not get compromised. Now, other things may go down, like discretionary products, consumer discretionary, and other products may see a pretty harsh recession, but aerospace and defense does not, which means in good times, sometimes it's underappreciated. People forget about it. Right now, I think we're doing really, really well. The S&P and the NASDAQ have been going up for 2 years. So I'm going to start looking at these a little closer. So these metrics look good. A P of 20 look good. And a price to free cash flow ratio looks decent. These are not numbers that I'm like flying out of my seat thinking they're super impressive. But again, it's a more stable, less risky industry. These stocks will be around for a long time. All right, so what I started to do was taking a look at specific data for each company, and I started to create valuations for these companies. And I've gotten the first 2 done, and maybe we can do about 3. Takes like 3 minutes per, and then we'll finish maybe 5 or 6, and then see where these things sort themselves out. So RTX was the first one on the list, and it has very good cash flows, But the cash flows, and what I do, kind of take you from the top. Discount rate's going to be 8%, which is because interest rates have been falling. I think 8% is good for this industry. The growth rate, I'm looking at their revenue growth rate for the last 6 years and running a rate of return for 5 years. You can see the formula up here. And I put the first year here and put the last year here. And you put a 5 in there, even though you're looking at 6 years, because you're looking at 6 years of data and it's 5 points of change. And then with free cash flow, and I have those flipped. This is free cash flow that I just showed you, and then revenue is here. Revenue has expanded quite impressively for RTX. This valued quite well when you look at free cash flows. The free cash flow forecast, I'm taking 2023, and I'm adding the 5% growth. That's year one, and then each year is going to grow by 5%, getting to a terminal value of 172 billion. The current value, net present value of those cash flows is going to be 138. The debt is a little bit high. It's okay. It's less than 3 times EBITDA, so I'm not disqualifying it on that metric, but it just brings down the value in my book. And this stock's actually being priced at a premium if you look at their cash flows. And if you look at their earnings per share, it's priced at a discount, but overall, it doesn't look all that great. It looks okay. If you really wanted to be in RTX, that's one way to go if you really, really like the company and think they're going to do really well. Lockheed, similar process, took it, same thing. It revealed a 12% discount when it's all said and done. So I go, whoa, that looks pretty good, because this is a stable company and they do pay a dividend. I think their dividend was in the 2s, like a little over 2%. Textron, let's take a look at Textron. These numbers are not complete, so we're going to do that one step by step. And what I'm going to do is open up one of these guys, and we'll go to TXT. So Textron operates in the aircraft, defense, industrial, finance businesses worldwide. Six segments. So it does aviation, and it's right at the heart of aerospace and defense. Okay. It is a $15 billion market cap, which is quite a bit smaller than Lockheed and RTX. Okay, so what I'm going to do is I'm going to put this particular tab on another screen so I can multitask, and then we will complete the valuation together. Okay, so we have Textron. We're going to go at 8%. And now let's start with free cash flow. So free cash flow is 728 million. That seems to be kind of a low number. It's in previous years, it was 864 in the full year of 2023. So I'm going to go with 2023's number and then grow it from there. Let me park that number, which is 864 million. Looking at how their cash flow has grown over time, when I look at the last 6 years, it has grown. It's gone from 738 to 864. And when it comes to growth rates, the higher number of periods, the better, because then you truly get an average growth rate. If you just went like 2 or 3 years, it's hard to get an overall average. I'd probably prefer to make a judgment call if I only had a few periods. But with 6 years, that's pretty good. 4% growth on free cash flow. When it comes to revenue, we have revenue going from pretty flat from 13,906,000,000 to 13,628,000,000. So it's saying 0 because it's very little growth. It actually went down a little bit, so it's down to 0. But free cash flow did grow by 4%. So I'm going to change this to 4%, and then long-term 4%. So I'm going to take this number and I'm going to grow it by that 4% growth rate, since I do expect that going forward, it's going to grow at 4%. All right, it gives me an intrinsic value of 21 billion. Now let's take a look at the balance sheet and see how much cash they have as well as debt. So they have cash of $1,289,000,000. And then they have debt of, total debt is $3,958,000,000. All right, so that is $18 billion of value. When we look at the market cap, it's sitting at $15,110,000,000. So we have a total debt of $3.9 billion. Just to double check, what's our EBITDA number? Make sure that's within 3. EBITDA is $1.65 billion. So they can pay their debt off in about 2 years, 4 months or so. So that's below the 3 years. So I'm good with debt. It's not too bad. Total shares outstanding are 185 million shares. So it's sitting at a 22% discount if we look at their free cash flows. Now looking at their earnings per share that I expect in 2025, I expect $7.15 in earnings per share. We'll leave that at a 20 growth rate. It's supposed to grow better than that, so I'm gonna go with 7, and that gives us a stock price of 158. So this is looking pretty interesting. This one's about a 44% discount. It's also a smaller cap stock. It may have been left behind a little bit because smaller caps haven't kept up with the big caps over the last couple of years. So this one's looking interesting. All right, so let's keep going down this list of stocks that we were saying, hey, this is a good list to look at. So we've gone through 4. Let's go through number 5 and see if that gives us enough of a good data set to look at. All right, so next one we're going to look at is LHX. And that is L3Harris. And that's a $46.9 billion market cap. So that's good that we were looking at multiple market caps, right? We're looking at the biggest one in the space, I believe might be RTX. I think Lockheed might be the second biggest. Textron is kind of one of the smaller ones. And then we have one that's more mid cap. So that'd be a nice data set to work with. And just to show an example of which one looks the best from an investment perspective. Okay, so we've got TXT done. Let me go ahead and copy this as a starting point. Okay, so the symbol here is LHX. That is L3Harris. You'll keep this the same. And let's start with free cash flow growth on this one. So free cash flow for LHX has gone from, for the last 6 years, it's gone from a little over $1 billion, and it's grown to 1,647. So it's grown at 13%. Wow, good job. And that's a pretty good expansion of free cash flow. Very good. And the trailing 12 months is higher than that. It's at like 1.8 billion. So that looks good. All right. So the revenue, let's take a look at that. And the revenue is, it went from, wow, that's big growth. So let me just show this to you real quick, just to kind of make a comment. So on revenue, right, we're going to go, if I use 6 years, we're going to go from 6.8, and then it jumps up over 1 year, right? So they probably acquired, merged with a business. So I think this would skew my growth. It would probably show me an average that I shouldn't take into account. Instead, I should start with 2019 and then see what the growth is to 2023, which gives me a more realistic growth rate on revenue. So that's a judgment call on my side. So I'm gonna look at the last 5 years, which has smoother data, and I could really get a growth rate out of that information. So that's part of, as I look at the data, I have to make those decisions on, hey, I want the most accurate growth rate at the end. So that was a decision that I made on that particular data set. So I'm going to change this, is the formula actually has to change to only include 4 years, or I should say 5 years, but you have a 4 there because you have 4 different compounding events year to year. And we're going to go from 18,526, and then the final year is 19,419. So it gives us 1% growth rate over the last 5 years. If I would have used that other number, maybe it would have been like 5 or 7%, and it wouldn't have been as accurate as I would have liked. Free cash flow is growing really nicely. So it's growing nicely. So I'm going to give it a 7 and then use the trailing 12 months on this one here. Trailing 12 months of free cash flow. L3Harris is 1792. Okay. All right. So I'm going to add the 7% to that. Okay, so we have our cash forecast. We see the growth rates that we've seen historically. I'm going to grow cash flows by 7 and then 4 there. So it gives me a intrinsic value of 48.5. Now looking at cash and total debt, we have cash of 539 million and then total debt of 12,910. Now, when we compare that to EBITDA, their EBITDA number is 3.71. So if I divide close to 13 by 3.71, that gets me a little over 3. That would be at about a little over 3. So just to do the math real quick, we go. So it's closer to 3.5. So that is a little concerning. It's probably from that acquisition they made back 5 years ago. And if I study their debt, yeah, their debt rose back in 2019. It rose from 2.7 up to 6.7. And then for some reason between 2022 and 2023, it rose again. Good news is it's dropping, but it's still a little uncomfortable here. This is, since the debt is higher, I'm going to go with a higher discount rate. It's a riskier company. So this is a risk item, okay? So 3.5. I'm going to leave that there just as a reminder. All right, so we have our numbers in here. Our market cap for the company is 46,940. Shares outstanding 189. So this one here, if we look at free cash flows, it's got a 35% premium. That's a little bit little expensive. Now let's look at earnings per share. So earnings per share is going to be $14.55. And it's going to grow nicely. So I'm going to go with 6. So this one here is, it doesn't look good on the cash flow side. It's a little riskier with that high debt. Overall, it's being sold at a premium. This is the middle mid-cap stock that we looked at. I'm going to call this one the small cap, which is Textron. This one has a nice discount at 44. It had an okay balance sheet. And then the big cap that looked good was Lockheed at 12%. And then RTX is being sold at a premium. So the two that look good are Lockheed and Textron. Looking at Textron, it does not pay dividend, which is fine for me. Analysts agree with my conclusion. Analysts think it's discounted by 25%, and I felt that it was discounted by 44%. I base it mostly on cash flows, and I have even more optimistic view on the earnings per share. But it's good to see that Textron is also, analysts believe it's discounted. Lockheed, analysts believe it's discounted by 14%. And I think that one, I'm pretty close to what analysts are thinking. So these two are pretty good investing ideas. Just off the cuff, not ready to make a decision on investment. but I think that this one looks a little better. And I'm also favoring small caps because I think they've been left behind and are probably discounted better than big caps. So that's the logic of using a stock screener, looking at an industry and trying to see which are the best companies. You can do some of that filtering through just looking at the metrics that are provided by companies and then doing, kind of like putting in the sweat equity of looking at specifically their cash flows, looking at their earnings per share, looking at their balance sheets. You could assess what's the risk of the company and then getting to a conclusion of which one looks the best. And if we look at this list, especially the top 4, for me, I think Textron looks really good. I couldn't argue with an investment in Lockheed since it's a well-known name as well. So let me stop there. Take any questions, any observations or comments.
Yeah, I just want to say thanks. That's pretty interesting stuff. For me, Lockheed was on my mind because it's always been a big employer where I'm from, right? The Bay Area. Like I knew several engineers who used to work there. Of course, they couldn't talk about what they worked on, but I mean, I know that they've been moving operations elsewhere. And I wasn't sure. I felt like the company was in a little bit of trouble for a bit, but yeah, I knew that they were still there and they still had a lot of potential. So looks like they're doing okay now.
Yeah, I think what I'm going to do is I'm going to open up a graph and compare the 4 companies we just saw to each other, see where the stocks have been over the last year or so. It might kind of reveal that, hey, one stock's kind of sold off, but kind of created an opportunity. The financials tell you, they give you evidence, data of how healthy the company is, right? And they have to be accurate or else they get in a lot of trouble like Super Microcomputer. They're in a world of hurt right now. They are in no man's land. All right, so here are the 4 companies we looked at: Lockheed, RTX, Textron, and L3. And if we look at the past year, Textron, which ended up being my favorite, you see the performance 5%. It's been left behind. And then Lockheed is the second worst performance, which means it was left behind a little bit when you compare it to RTX and L3. Now, the past doesn't tell you what the future is going to happen. Sometimes it does. It's one data point. But I would say that looking at the fundamentals, this company and this company looked better because we always compare to their stock price. And this stock price is a little overpriced, and this stock price is overpriced. So I like what I'm seeing there. Over the last 5 years, RTX isn't looking too hot. Lockheed is looking pretty good for us. A low risk stock to return with the dividend. I would assume it's like a 2% dividend over 5 years. This would be at about a 55% return. You're looking at about call it a 10.5 rate of return. Not bad for a low risk stock. Textron 72. Wow. So it had really nice years in the past, but more recently it's really pulled back. It's been the top performer for the last 5 years. So that's an example of looking into one industry, trying to reveal which is the best stock, why this industry, because it's lower risk. It's a good way to diversify a portfolio, especially for an older investor like myself at 56. I am looking for stocks that are more reliable, and I can kind of see a good return. I don't have to break any records. I just have to keep growing my portfolio at a good rate. Yeah. So, all right.
Can I add one thought? It's just kind of interesting. Yeah, it's just because you were mentioning that defense industry can only normally sell to specific countries, right? And so in addition to that, there's also something called the export license. And that means, so for example, this is actually an issue here in Europe. Swiss companies, right? So not Rheinmetall, but so there's Swiss tank and firearm manufacturers that will sell to Germany. Now, Germany would like to give those on to Ukraine, but because Switzerland is still a neutral country, right? Not NATO, and does not support ongoing conflicts. And so Switzerland says, no, sorry, you cannot send our equipment on to an ongoing conflict. And so that is also something to keep in mind, that there are these export licenses.
Yep. Yeah.
And so in theory, I mean, Germany could just say, well, F you, we're going to send it anyway. But then, okay, then Swiss companies would probably never sell to Germany again.
And here in the U.S., not sure what they would do in Switzerland, but here in the U.S., if let's say Lockheed sold to North Korea, the government would do an investigation and they would find who made the decision, and most likely that person would be penalized criminally, and they would probably have to go to prison. So there's very strong
Sure.
safeguards against that happening. So it's just not going to happen. If it
Sure.
happened by accident, like a Lockheed would self-report and say, "Hey, we sold to," just making this up completely. We sold to the Army, and then for some reason the Army decided to sell it to somebody else, and we wanted to self-report because that shouldn't have happened. And then the government would complete an investigation and see what happened. All right, so we looked at those. Now let's get into a couple of stocks that you guys wanted to take a look at. We'll start with Etsy, because that one's going to be fun, and then we'll go over to Shell. So Etsy is it's a e-commerce site. Let's see what they put it. See, consumer discretionary, internet retail, and what makes them different is this is where artisans or a person that creates crafts, especially personalized items. And we have my wife has a cousin. It's our cousin. It's from her side of the family. She's like so gifted when it comes to like crafts that she started her own business, and she gets these orders. Like it's the season when she's super busy, and she gets all these products made that are very personalized. And that's what Etsy's about. It's about buying something that is unique and personalized, and that's what sets them apart. The forward PE looks really good at 10.96. The current PE looks okay. One of the things that I've disliked about Etsy is that they most definitely are different, which is good, but it's hard to scale up a business like that because, again, our cousin that has this business, she just can't like triple her volumes because she can only work a certain number of hours, and she has her kids and she takes care of her kids. And so she just does it to, and she's governed by the number of hours she can work. So I think that's one of the limitations on Etsy is you don't have like a super scalable business. For example, Meta has a platform. If 1 billion people want to start using Meta next year, no problem. 1 billion people will be served the social applications that they want to view. Etsy, the crafts, the vendors on Etsy, they can't scale up that fast. So growth for this company, in my opinion, is always going to be governed by that fact. And we see that growth has really decelerated in recent years, down to 3.14% in the trailing 12 months. The most recent quarter was a little better at 4.1%. But for a company that's not that big, pretty good size, 2.8 billion, the growth isn't there, right? Amazon's growing at like 13 or 16%, and they're humongous. So if those guys are growing that fast and they're much larger than Etsy, there's kind of something wrong with this model to some extent, because they should be growing much faster when they're in small scale. Having said that, it's not a giant market cap. It's a $5.94 billion market cap. So let's take a look at the fundamentals. And out of curiosity, over the last year, this stock has really not been getting a lot of shareholders. It really had to run up during COVID, right? A lot of people started doing things on the side. People wanted to buy things that were more personalized, but it really hit a peak, $294 per share, and now it's selling for, probably about 15 to 20% of that value, which is a big sell-off. Over the last year, it's sold off by about 15%. So high level, do I expect Etsy is going to be like a $25 billion company at some point? It's hard to imagine that. I think they're going to slow grow, and that's one of the realities, which does not excite stockholders. Looking at their cash flow is good, and they've grown it over time. If you look at their cash flow, and it's a slow grower, so maybe I multiply that times 15, I get to like 10 billion. They don't have any debt. You can very easily value this stock at a discount. So I think this one will value at a discount, assuming that their balance sheet doesn't have a lot of debt. And I'm going to guess they don't have any debt. So they have $2.39 billion of debt, $1 billion of cash, so $1.34 billion of debt. So they don't have a debt problem. That's good. One of the other stocks that I've tracked over the years is eBay. And if you look at eBay and Etsy remind me of one another, because eBay also, there's like one-off products that are being sold, like a used this or a used that, or some item that's unique, and they have that scalability problem that I was referring to. It's hard for their vendors to really sell in high volume, whereas on Amazon, that's not an issue. And if you look at this stock, it's done okay over the last 5 years. It had a nice run up during COVID, but it has really collapsed since then. And over the past year, it's done pretty darn good. So this one here, if you bought at the right time, you would have done well. Looking at the growth, see this slow growth? This is why it reminds me of Etsy. And you see this business, they were at $9.9 billion business in 2017, and they're not much bigger today. That's my point on eBay and Etsy. And as an investor, I'm like, well, this means that, meanwhile, if you look at Amazon, they have just grown immensely in that time. So you look at revenue, Amazon was 177 billion, and now they're $620 billion. Humongous. That's like 4 times bigger. And these companies have not grown. And this one's grown much nicer, but it's much smaller. If you stop growing here, they're probably going to follow a growth trajectory that eBay has followed. So this one, I can't argue that it's discounted. It most definitely is. I would just not want to invest in it, because I'm like, if they're going to be like eBay, there's just too much risk. And eBay did have some really tough times, right, for their stockholders. If you look at a stockholder that bought here, a year later, they're losing money, and they lost money for a while. And more recently, it started to rally, and very recently, it really sold off. So I would not want to buy into Etsy or eBay, because Amazon's the gigantic monster in the space that just keeps taking a lot of value from the space. And the other piece that I would also say is out there as a competition to Etsy is Facebook marketplaces. I don't know if you guys are familiar with that, but on Facebook marketplaces, you could actually sell these kinds of crafts, and it fits into kind of like more of a community kind of little business. And again, our cousin sells on Facebook marketplaces, and she sells on Etsy. So that's how I found out about Facebook marketplaces. So I know Brad, you had brought that one up. What comments or questions might you have on Etsy?
I come up with kind of the same conclusion. I did like the fourth quarter. Fourth quarter is always their big quarter because it's Christmas time.
Yeah.
And you'll see when you compare 2023 to the trailing 12 months, we don't have quite the fourth quarter in there yet. And their fourth quarter is normally pretty good. But yeah, I did see a discount as well.
Yeah. Yeah, you're right about the fourth quarter. It sequentially, when you go third quarter to fourth quarter, you see that bump. Yep. But if you compare fourth quarter of 23 to fourth quarter of 22, it's not growing all that much. It's growing 4.35%. So right there with its growth rate. I think it's a neat business. I think it's neat for all the participants in it, but we have thousands of stocks to pick from, and we're trying to pick stocks that are going to make us a lot of money, and not necessarily just be a neat idea. There's some boring stocks that I own that make a lot of money, and I'm like, okay, I'm fine with that. All right. Thanks for asking about Etsy. Let's talk a little big oil now. Shell. So Shell, we did review when they announced their earnings this past week, and I found out that they were founded in the Netherlands but have been moved to UK. And when we looked at it, it looked good. A couple of things that look really good. Look at this forward PE. That is like super low, 8.81. Oh man, analysts think it's discounted by 23%, and it's because of that oil price, right? If you look at the past year, oil hasn't been all that high, oil prices. So the stock has just gone up 3.61%, and they're not paying a dividend currently. So that's one thing to be aware of. I would expect they are going to pay a dividend at some point, just because their industry pays a dividend. But at this time, they're not paying one. The revenue has been contracting, probably due to that oil price being low. And when we look at the quarterly, we're seeing red on the screen. Not anything that I'm overly concerned about, because that's mainly driven by the commodity price. It's not that Shell is doing a terrible job. with the lower oil price, they have a gross profit and they're still profitable. So good. They're still profitable. They've been profitable for the last 3 full years. And then the trailing 12 months, they have a nice net income. Free cash flow is really nice. $34 billion of free cash. That looks really, really good. If you multiply that times 10, you get north of that 200. You get to about 340 billion. And this thing's market cap right now is 207 billion. So it looks like it's discounted. So Shell's a good option. Chevron's a good option. Exxon's a good option. Like, I think you're buying similar companies. I buy Chevron. I can't argue with Shell. It looks pretty well discounted, and looks like a good idea. You see this trajectory here after COVID. It's gone on a really nice trajectory. That looks really good. Tomas, you have a question?
Just a little comment. Shell is actually paying a dividend since a few years ago. I own the stock, and I always get the dividend. So maybe it's the stock analysis website that is not indexing properly, but they do pay a dividend.
And yeah, thanks for sharing that. If you look at Shell from October 2020 to 2024, investors more than doubled their money. And so it's been really going up, and the chart looks pretty good. And thanks for clarifying on the dividend. Yeah, it's kind of weird that stock analysis showed no dividend, because oil companies are known for paying dividends. So that is Shell. Go ahead, Scott.
Yeah, just quickly, I don't know if you were going to talk about Pump, the ProPetro holding, but so that's a company that I did put on my portfolio, and it's actually been one of the biggest losers of the past month or two. But I haven't sold it yet. I think I'm going to hold on. But my suspicion is just because not only oil prices, but because it's a small cap, right? Relatively small cap.
Yeah.
That it's a more risky section.
Well, I think so Pump really focuses on fracking. And if you have the low barrel oil price, or low oil price per barrel, then the prospects of fracking go down. So that's why these guys are getting really discounted. The stock's really going down. If you have a rising oil price, these guys are going to rally, because the oil companies that own the rights to extract oil in the places where you need fracking, it's just going to really go up. So this one here, I mean, the smaller the company gets, right, and this one is a small one, $677 million, you get this volatility, and buying at the right time is critical. And it's unfortunate you're currently sitting on a stock that's come down. It's come down quite a bit. And oil prices have been recovering, but they had a really bad day when Israel announced that they attacked Iran, and they stayed away from bombing the oil complex of Iran. That's when oil prices went down like 5 or 6% on one day. Oil has been recovering, but we'll see how quickly that happens. All right, so let's take a look at Opendoor. That's what Open is. And what does Opendoor do? Opendoor Technologies operates digital platform for residential real estate transactions in the United States. It buys and sells homes. Wow, so they buy homes, huh? That sounds pretty risky. Whoa, that doesn't look good. It's only down 4%. So market cap's really low on Opendoor. Revenue is much higher, but you see these losses. That's where the money's being lost there. Analysts think it's really discounted. So the revenue's really come down. I think that real estate, like individual properties, when corporations try to participate in that market, it usually does not end well, because they're competing against individuals that are doing the homework, buying at the right times, buying in the right areas, and so forth. And when big companies buy, they tend to buy across the board. They buy a lot of bad properties, and I'm sure they buy a couple good ones. But when it comes to individuals that know areas, the 3 rules of real estate are location, location, location. They know where a desirable property is, and they know pretty much what it should be priced at, where corporations make a lot of errors. There's also the carrying cost. It's more expensive for them to manage and administer these properties, where individuals, I mean, they're competing against a whole, you know, network of independent real estate agents and independent real estate investors. So these things usually don't end well. I think structurally, I don't like the business of Opendoor. I think it was not a wise idea, and the market's really, really punished the stock. It's down to $1.81. This one would be a, if you think they're going to announce something favorable, the stock would easily double, because if it doubled, it gets to $3.64. So if they had any hint of good news, this stock's really going to run up quickly. And I think that's what, some investors may be playing, or might be traders might be playing, that, hey, if they have any good news, I could really make a lot of money quickly. And that might be the case. But for me, I just don't want to participate in something that's very short term and far less predictable than the method that I principally use. Even the method that I use is very difficult. It's very difficult to know when, like a company like Pump, we see that I think it's really discounted, but other factors are affecting the stock price. And for a period of time, it's sold off. At some point, I expect it's going to rise. I just don't know when. But a company like Opendoor, out of the gate, conceptually, structurally, I just think it's the business that I just don't believe in. So I wouldn't enter a company like this for the long term, and therefore would probably just eliminate it on kind of the initial steps of evaluating the company. Out of curiosity, let me see if they're producing cash flow. No, they're burning cash in the trailing 12 months. That's bad. And you see their data. It's really hard to make a forecast if you have such extreme variation in the data. Like you had negative 5.8 billion, positive, negative. It's like, what's going to happen next? I have no idea. It's really hard to predict this business. So I would not be, I can't add a lot of value on Open Technologies. And it's just not a business that I would want to invest in. Let's take a look at Grab. This is the company described by Bobby in the UK that is supposed to be the Uber in Southeast Asia. Super apps in Cambodia, Indonesia. Okay, cool. Very cool. Okay, that looks really interesting. So they're doing what Uber does. Maybe they'll be acquired by Uber. They're a $16 billion company. All right, that's pretty good size. And $2.58 billion of revenue. They're losing some money, but let's take a look at their growth. PE 271. It's a strong buy according to analysts. Let's look at their growth. Nice growth, trailing 12 months at 30.77%. They were growing really fast, but as you get bigger, it gets harder to grow at those high percentages. But 30.77 is pretty good. Looking at the quarterly, they haven't announced a more recent quarter, and I'll take a look at that in a sec, but you see their revenue is slowing down. That is a concern. So Q, yeah, that's a concern of 17% is okay, but it just doesn't excite me. And they're still relatively small. Let's look at Uber and see what their revenue is and what their growth is. So Uber is a $42 billion revenue company, and they're growing at 16%. I didn't mean to. Oh, here we go. Here's Grab. So, and then Grab, when we look at the revenue is 2.5, and they're growing at 30%. So Uber is substantially bigger, maybe about 15 times bigger, and they're growing at 16%. These guys are growing at 30.77. But when you look at the quarterly, they're at 17. Uber, looking at the quarterly, they're at 20%. So Uber is actually growing faster in the most recent quarter, and they're much larger. So I think Grab's interesting, but so far the fundamentals are not exciting me. I'm like more cautious than I am excited. Like, okay, they're not growing fast enough, and they may hit a wall. Their name recognition outside the countries they operate in isn't there, so they can't expand outside of those regions. But I bet you Uber can probably enter their market and start competing against them. So cash flow wise, let's see. So free cash flow is positive. That is very good. It was negative in previous years, but now it's positive. That's really good for the company. So if they're growing, and I multiplied this times 30, we get to about 1.5 we get to about 15 billion in market cap, and they are priced at 16 billion. So they're fairly priced. They're fairly priced, assuming their balance sheet's really good. They should be really good because they're kind of a young company. Total debt 295, cash 493. So they're fairly priced. This is a fairly priced stock. Being in the U.S., right? If I was in one of the countries they operated in, I'd probably feel different. But since I'm in the U.S., I'm going to stick to my Uber investment and keep buying into Uber. I think it's lower risk with the same rate of return, possibly even better. Unless Grab really starts to grow their business, I don't think it's that exciting of a small company. They still are fairly small, $2.58 billion in revenue. I think it's great that they're operating in the Southeast. Hopefully they can find a way to accelerate their growth. If they did, this stock will really keep going up. But I think the stock's really run up recently. I think this is why it's catching attention, is from October 17th to the 24th, it's gone from $3.62 to $4.07, which is exciting. The other thing I don't like is these low stock prices. You know, on the first read, you're already concerned. Why is the stock price so low? Why has it sold off? It should be priced at $25 a share. It should be priced, somewhere where it's normal. Back when it IPO'd, it was trading at, $12 to $16 per share. Now it's really fallen. So that is another area of concern. So Grab's an interesting company, but I don't know if it's a stock that I want to touch. If I see their growth in revenue, maybe. Hims and Hers, this is a pretty popular stock. It's a small cap stock that's really done well. Look at that, 240%. Wow, incredible. But over the 5-year, it's only up 107 because it IPO'd, it really went up, and then it came down harshly. Every time I look at Hims, it is an exciting stock, but it feels like it's priced really expensively, and the best is behind the stock. It may come down substantially, and then investors are kind of holding the bag. They're growing at 50%, but they're still fairly small, a $1 billion company. We look at the quarterly, the revenue's still strong. Good job. Growing at 51% in the quarter is excellent. Good job. So looking at 50% growth, and we look at the cash flow available on this company, they're doing quite well when it comes to cash. Trailing 12 months of 100 million. Yeah, it looks good. So 100 million. This company's worth, 3 to 6 billion, depending on how you value it. So it's right there. It's fairly valued, or maybe valued at a small discount, valued at a small premium. But I think the stock is priced fairly. I always have a concern with Hims and Hers ventures into kind of like the pharmaceutical space, and that's where I think they're going to open themselves up to potentially either being sued by other pharmaceutical companies for patent infringement, or the FDA gets on their case about some of the claims they make. They may start seeing some of that pressure, and that would cause them to stop selling products as well as have a lot of legal fees. But that's my feeling on it. It's been an interesting stock. People that are invested in it, congratulations. You're doing great. You took a stock that was being priced at $6.48, and you have tripled your money. So congratulations on that. All right, so that's the list of stocks. So really good session. We went over a specific industry, and we're able to take a look at the aerospace and defense industry to look at some stocks. This would be a less risky industry. Speaking for myself, 56-year-old, I'm interested in this space. But if I was 26, I would not be interested in this space. It's not growing fast enough. Go find the next Uber or the next Hims before it went up 240%. Try to find high growth is what I would tell my 26-year-old self. So we went over looking at companies in the aerospace and defense, trying to get a stock screener to focus in on which are the best stocks to look at. We looked at them, and coming out of it, I feel that Textron is the best, investment proposition for me. Second place is Lockheed. And then the other two would not be investments that I'd be interested in. But these two, I would most definitely be interested in looking at investing. And I especially like this market cap of 15 billion on Textron, because I think that could move up quite quickly. And they did have the best 5-year performance, even though the 1-year performance was the worst. So it feels like I'm getting it at a discount and can see it rise. So I'm going to be tracking that and following it. Then we went over some individual stocks. Hopefully you guys saw those and found it interesting. And that's it for the presentation section of it. What other questions might you have?
And none for me.
Excellent. Well, thanks for tuning in, Tomas. Hopefully you're having a nice weekend. Tomas, do you guys celebrate Halloween in Argentina?
Well, it depends of the city. It's not a national thing, but in some neighborhoods, yes, you can see kids asking for candy on the doors. But because it is not a tradition here, nobody opens up. So it's kind of a new thing.
When I was in Mexico City in 2022, we were there for a while. I spent like 6 weeks in Mexico City, and we were advised that Halloween has become a really popular, I'm going to call it an event. They don't call it a holiday. But kids like the idea of, hey, this is fun. We get to dress up. Even young people and adults like the, I guess, if the reason to get dressed up and then ask for candy, which was we really need to see in Mexico City.
Yeah, it's gaining a lot of traction here. People is liking it, but it takes some time, because it is still new.
Awesome. All right, guys. Well, that is the session, the workshop for the week. Thanks for tuning in. Thank you for all your support. And just reach out to me if you have any other questions, and I look forward to seeing you on the live streams. And again, we're going to have tomorrow's investor call if you want to tune in. We'll just have a good open conversation around companies that have announced and then companies that are going to announce this coming week. The companies that are going to announce next week are lesser known, but I think are very interesting because they're smaller caps compared to the big giant market caps. So we can talk about that and any other stock that you want to bring up. So tune in if you'd like.
Sounds good.
Hey, thank you.
Yeah, you're welcome. You guys have a great day. Take care.
Same.
You too. Thank you, Victor. Thanks, guys.
All right. We'll see you guys.
See you. Bye-bye.